So you're interested in swing trading? Stick to the end of this video and I'll show you the full strategy so you can get started swing trading today. First, let's talk about what swing trading actually is. Swing trading is just a fancy term for a strategy of holding a stock more than one day. Anything within one day is an intraday trade. It's day trading. So if you hold it from one day to several weeks, typically is swing trading. Longer than that, sometimes we call it position trading. Okay, let's turn our attention now to the stock market. I've loaded here the daily chart of Apple, AAPL. What I want you to do is load two indicators. They're both going to be exponential moving averages. Here I'll type in exponential. There it is, moving average exponential. I'm going to click that twice. And what I'm going to do now is change the settings of these. Here I'm going to click on this settings button. I'm going to change one of them to the 10 exponential moving average, and I'll also change the color to orange. The other one, I'll click settings, and for this one, we'll use the 21 moving average. And I'll change the color of this as well to green. Now you see they have populated on my screen. So we have our moving averages loaded. Now how do we use them? There are two things you need to know in order to use this strategy. One is they cross over. The 10 moving average crosses over the 21 moving average to the upside, or the 10 moving average crosses below the 21 moving average on the downside. The second thing is the stock then pulls back or consolidates to the 10 moving average before going up higher. Let me show you what I mean now. Here we see that the 10 moving average, the yellow line, crossed over the 21 moving average, the green line. It then went up, consolidated a little bit, and then put in this green bar. This green bar would be an indication for us to get in. One of the things that I want to clarify with this strategy that I feel a lot of people fail to explain is that just because the moving averages cross over doesn't mean that you automatically get in. There has to be a good setup, meaning the second step that I mentioned, either consolidation with the breakout on the 10 EMA or a pullback with a green bar on the 10 EMA. Just because they cross over doesn't mean you blindly get in. The crossover simply tells you that there is a potential trade upcoming. So with that in mind, let's look at the same example. The stock moved up, crossed over here. Now you'll notice the crossover comes at this red bar. That doesn't mean we get in on this red bar, nor does it even mean we get in on the next red bar. The crossover simply tells us that, hey, there's a potential trade. The potential trade actualizes right here at this green bar where the stock consolidates back close to the 10 EMA, which is the yellow line, and then busts up further. This is where you would get in and you would hold. So here we see another example. The stock was moving down, the 10 was under the 21, then it does this kind of little loop, and then here it's kind of blocked off by this green bar, but there's a crossover of the 10 on the 21. Now remember, what does that mean? That's telling you, hey, there's a potential trade. That should make you raise your eyebrows. So we wait, the stock consolidates back to the 10 EMA, and then boom, busts up. This bust up green bar tells you that this is likely a real uptrend. So you get in here and you would hold, and that would be a great run right there. Now let me show you this example, which clearly depicts what I meant by just because there's a crossover doesn't mean there's a good trade. So here we have a crossover right here. The 10 is moving above the 21. If you were simply blindly getting in because you think that the crossover means get in, you would have not had a good trade. But if you were smart and you used the strategy correctly, you would have seen that this made the crossover, it goes up, pulls back to the 10 EMA, and then falls lower. So there was no entry here. There was no entry here despite there being a crossover. So here we see an example of a good trade. The stock moves up. There's a crossover right here of the 10 on the 21. It moves up further. I would not get in here, even though it's tempting because it's shooting upwards. I have still not seen a good pullback or consolidation to the 10 EMA. Now, Then the stock goes up here, pulls back to the 10 EMA, and then continues up higher. I would get in probably at this green bar here. So see how it perfectly pulls back to the 10 EMA after the crossover. So this pullback is our signal that we might be going up higher, and indeed we did. Let me show you one more here on the upside. So here we see consolidation. The stock kind of goes down lower, pulls up. There's a crossover right here of the 10 crossing above the 21. The stock goes up, pulls back here, beautiful pullback to the 10 EMA, and then this green bar, this next higher green bar, is our signal to get in. That's telling us that this stock is likely going to go up higher, and indeed it does, for a great trade. Now let's see a couple examples on the downside where the same principle applies. Here we see the stock goes up, starts going down. Right here, we see a crossover of the 10 EMA below the 21 EMA. It's right on this bar. But remember, that doesn't mean we just sell the stock. We wait for the next pullback or consolidation to the 10 EMA. And here we go. The next bar goes closer to the 10 EMA. This red one is a pullback right to the 10 EMA, and then boom, this red bar tells us we are likely going lower. You would get in on this red bar and you would have a nice trade. Now let me show you one more example that's a good depiction of a fake out and a true downside trade. So here we see the stock kind of consolidates, pulls up. There's a crossover right here of the 10 EMA above the 21 EMA, which may make you think, we might be going to the upside. Now the crossover is right on this green bar. So you would be waiting for what? A pullback or consolidation to the 10 EMA after this green bar. And so it goes a little higher, but you see there's no pullback, there's no consolidation to the 10 EMA. Indeed, it breaks right through it. If you had just blindly gotten in when the 10 EMA crossed over the 21 EMA right here, you may have had a little bit of profit, but then it came down really hard. So you have to make sure you don't just get in blindly. Now, as we go further, we see that there's a downside crossover here. It crosses over right on this red bar. Does that mean we get in right at this red bar? No, it does not. It means we wait for a pullback to the 10 EMA. So here the stock kind of goes down further. This is not a true pullback to the 10 EMA. It's still far away. Here we see it consolidates all the way back to the 10 EMA, even touches the 21, and then boom, this red bar here indicates to us we are likely going lower, and indeed we did. Again, that example highlights an important point that no strategy is perfect. No matter what indicator you use, there will always be good technical analysis and judgment necessary to make a good trade. Guys, if you enjoyed that video, please like, share, and subscribe. I have much more content coming your way. Thank you. See you next time.